Stop following the news, declared legendary investor Peter Lynch, and at first glance that blunt command seems borderline reckless. After all, the world is bristling with controversies and economic fears, trade tensions brewing across continents, new artificial intelligence breakthroughs sparking existential questions about jobs, and ominous predictions of an imminent recession swirling around every headline. Yet, according to Lynch, these constant waves of alarming updates can rattle even the most seasoned investors into making rash decisions, depriving them of the real benefits of long-term growth. Why is that idea so crucial to grasp right now, and how does it shed light on the electrifying tug-of-war between Wall Street heavyweights and everyday retail investors? Today, we are shining a spotlight on the fascinating reality that, despite every reason in the world to be terrified, global instability, inflation fears, you name it, the stock market has reclaimed territory near its all-time highs. In this episode, we are going to dissect exactly why so-called blissful ignorance can be a potent strategy, how regular monthly contributions are quietly transforming market dynamics, and whether retail investors may be on track to overshadow Wall Street's traditional dominance. We will examine the nuanced interplay between psychology, systems like retirement accounts, and the everyday avalanches of news that threaten to scare folks right out of their best opportunities. We will dig deep into 7 major questions. 1. How does the endless barrage of ominous headlines warp our investment outlook? 2. What exactly is fueling these relentless new record highs for stocks? 3. Is there a fundamental shift at play in the way we perceive risk? 4. Can the unstoppable rise of automated monthly investments truly stabilize markets? 5. Why is retail increasingly targeting growth, while other regional markets may be favoring classic value plays? 6. Just how critical is the role of new technology, particularly artificial intelligence, when we talk about the market's future? And 7. Could there be a direct correlation between so-called unstoppable job markets and unstoppable equities? Imagine a world where you feel your heart pound every time you read a headline about trade wars, or see the words global recession in bold font. It might seem logical to bail out of equities and hunker down in safer alternatives, waiting on the sidelines. But this, warns Peter Lynch, can be the most damaging mindset of all. He famously insisted that, in many historical periods, the greatest leg of market growth occurred exactly when the panic meter seemed off the charts. In simpler times, say the late 1980s or early 1990s, negative headlines would have convinced you to stay on the sidelines. Yet that was precisely when many investors, ignoring the clamor, quadrupled their money. Jumping forward to the present, we see echoes of that phenomenon repeating. Big indexes are once again charging to new heights, possibly leaving behind those who surrendered to their worst fears. But here is the twist. The steady surge of the so-called retail investor is no minor footnote in this phenomenon. Back in the day, institutional players were widely considered the primary power brokers of the stock market. Now, there are tens of millions of people in the United States alone, pouring a chunk of every paycheck into equities through workplace plans, like a silent tide, perpetually lifting the overall market level. Even if the news is screaming Armageddon at the top of its lungs, these individuals keep contributing month in and month out, buying into indexes and funds regardless of headline-driven dips. That unwavering approach has given markets a degree of stability that defies many of the gloom and doom predictions we hear every day. And why does this matter so much? Because constant buying pressure, even in times of turmoil, can diminish the magnitude of sell-offs. If fewer people are panicking and dumping their stocks, the entire system experiences less volatility, meaning narrower fluctuations that might lull even more participants into feeling safe in equities. As a result, valuations climb, and the market churns ever higher. That leads to a self-reinforcing loop. Less fear fosters more courage, which in turn fuels higher valuations. Some folks even argue that this phenomenon may only expand. As more employers start offering or expanding retirement plans, the monthly infusion into equities could intensify. If you have ever wondered why some corners of the market nearly laugh in the face of turmoil, whether it is recession warnings, policy threats, or worries about technology, this ceaseless flow of contributions is a significant piece of the puzzle. It might not make the markets immune to correction, but it might make them far more resilient than we have historically expected. That resilience was on full display recently. Despite seemingly insurmountable negativity surrounding technology, especially fears around artificial intelligence displacing workers, the market's appetite for so-called high-risk growth stocks has been roaring. Have you noticed how semiconductors, historically the most cyclical and nerve-wracking investments, have started exuding an almost defensive aura? Their profit margins keep surging, and the old idea that chip makers crumble at the first whiff of recession may no longer hold so strictly. In other words, lagging sentiment about the economy is being overtaken by the optimism of unstoppable monthly flows and a conviction that new technologies will proliferate in ways we have not even begun to measure. Interestingly enough, retail investors are not alone in their thirst for growth, but the rest of the world has lately gravitated toward more conservative plays, value stocks, stable dividends, safer havens. The contrasting behavior can be attributed to cultural differences, structural investment incentives, and varied outlooks on global risk. This divergence between the preferences of United States-based retail investors and those overseas might create friction, or it might open opportunities for truly global portfolios. But there is no doubt that the American market is currently leaning heavily toward growth-oriented companies, lured by the promise of advanced artificial intelligence, biotech solutions, and digital transformations across nearly every industry. But let us not skim over the skeptics. There are always going to be commentators, analysts, and old-school market watchers who insist that the higher these valuations climb, the more brutal the eventual correction will be. Could that be reminiscent of, say, the early 2000s dot-com bubble? Possibly. And that is exactly why some voices caution about flying too close to the sun. The difference in this modern scenario, as many analysts argue, is that the market is anchored by huge waves of investments from retirement plans. Unlike the frenzied day traders of earlier times who might vanish after a crash, these consistent monthly purchases do not simply evaporate. Therefore, we see the big question. Does all of this mean we should tune out every grim pronouncement, every negative indicator, and every caution sign? Lynch's advice to not obsess over the news is not a call to bury your head in the sand. It is a caution against the tyranny of noise, the day-to-day clamoring that can derail a carefully considered long-term plan. When the Nasdaq or the S&P 500 begin tiptoeing around record highs, seemingly ignoring the world's troubles, it can feel surreal. But there is a logical structure behind it, a steady inflow of capital linked to everyday workers investing in their future. It also explains why major indexes can sometimes appear somewhat divorced from Main Street realities. Picture a scenario in which many Americans are worried about layoffs, inflation at the grocery store, or rising rents. In theory, that adversity should translate into humbler equity markets. Yet, so long as most people continue to channel their paychecks into retirement plans that funnel capital into stocks, indexes might keep floating. It is not that the fundamentals do not matter, but the tide of consistent buying can shift the balance. Now, before we plunge further into how this phenomenon may continue shaping our future, take a moment to reflect on your own experience. Have you ever been tempted to exit the market after reading a doomsday article? Or felt that pang of regret as you watched stocks soar after you locked in losses by selling too soon? If this viewpoint resonates, consider giving a quick like or thumbs up to show that you, too, are interested in a deeper, clearer perspective on trends that defy the gloom. It is just one small way to boost our discussion. Of course, no matter how strong the tide of monthly contributions, there can always be tipping points. Let us say we face an intense global crisis, or a major policy shift that drastically burdens corporations. Nothing is truly immune from the laws of economics. But fear alone is not an investment strategy, and swinging in and out of the market on every scary headline is usually a recipe for missed opportunities. We have seen countless instances in which the dreaded meltdown did not materialize, while those who stayed the course found themselves rewarded for their patience. This is precisely the essence of Lynch's advice. Either you are in for the long haul, or you are subject to the chaotic swirl of headlines. Interestingly, technology is making long-haul investing easier than ever. Automated investing apps allow people to channel a big slice of every paycheck straight into low-fee index funds, ignoring the day's noise. Similarly, many employers now match contributions, increasing participation rates and normalizing the pay-yourself-first mantra. So, while once upon a time only the well-studied or wealthier class might have been consistent market participants, now everyday people can jump in with minimal friction. The ripple effect is enormous, providing a steadier support to the markets, and ironically reducing some of the high drama that used to characterize equity swings. If you believe in the unstoppable march of technology, a consistent investing habit seems more appealing than ever. Comparisons to earlier eras underscore this shift. Financial historians will argue that in the 1970s or 80s, monthly investing was less universally practiced. Without automated contributions, people might feel that knot of anxiety whenever the economy sneezed. Should I still put money in stocks this month? They would ask. Then one negative headline might keep them out altogether. Today, the standard approach is to set up a direct deposit and forget about it. As a result, the market sees constant inflows, diminishing the role of panic. But let us shift our gaze onto a broader horizon. What happens when the rest of the world's investors pick up on this phenomenon? Already, some countries are implementing more robust retirement savings frameworks. If this system becomes more universally embraced, we might see global capital markets halting or mitigating downturns faster than the doom mongers predict. Could it be that the future is one in which major indexes continue climbing more steadily, barring black swan events that momentarily disrupt them? Because the collective monthly buy-in from a worldwide population relentlessly supports corporate equity valuations? Skeptics would caution that no upward trend lasts forever, and we should not discount the possibility of large-scale corrections or even crashes. Humans are still prone to bouts of fear and greed. However, the puzzle piece often overlooked is that constant infusion from billions of paychecks worldwide, each dedicated to some form of equity investment, might be enough to shorten or moderate those brutal drops. So, yes, volatility will never vanish altogether, but short-term gloom may result in dips that prove fleeting. Speaking of gloom, let us not forget that the news cycle thrives on tension. Markets brace as recession looms. That is the type of headline that garners clicks. Meanwhile, there is a near-limitless sea of potential triggers for such fear: policy changes, international conflicts, supply chain upheavals, pandemics, you name it. Yet time after time, the market's reaction has been short-lived compared to how we might expect. And that begs the question, are we systematically overestimating risk because we are consistently bombarded by fear? Possibly, and that is why a strategy that ignores the noise can be surprisingly powerful. Of course, we must touch on artificial intelligence. Lately, the hype around AI upending job markets has soared. If you believe the more dramatic forecasts, human employees could become obsolete, undermining one of the pillars that drives consistent buying: income from jobs fueling retirement accounts. But a quick glance at major corporate surveys suggests that only a small fraction of businesses actively deploy advanced AI in their routine operations. Yes, it is growing, but many organizations remain cautious or uncertain. For now, the wave of human-driven retirement investing seems unlikely to vanish overnight. Could AI eventually spark productivity so immense that it catalyzes new industries, ironically creating more jobs and higher wages? That might be the next great twist. Let us also talk about that perpetual specter called inflation. No one wants their dollars to lose purchasing power at a quicker pace than wages rise. That fear alone can stir calls for caution in the market. If inflation runs rampant, consumer sentiment might take a downturn, compressing corporate profits. Yet here, once again, the news had been swirling with dire pronouncements, while more recent data suggests inflation in the United States is moderating, even creeping toward historically mild levels. With a backdrop of moderate inflation, the possibility of interest rate cuts, and unstoppable monthly investments, the bullish picture only grows more compelling. Indeed, we continue to see signals that rate adjustments are fueling yet more appetites for higher valuations, as the cost of capital becomes less of a looming threat. So, can the market keep shrugging off each new round of drama indefinitely? It sounds brash to claim yes, but the underlying conditions remain strong. The personal savings rate in the United States may have dipped to around 4.5%, but that still translates to a massive absolute sum funneled through millions upon millions of working Americans. A notable chunk of that savings continues marching right into equities. Combined with stable or rising employment numbers, it is not surprising that indexes are consistently flirting with fresh highs. The raw force of that unstoppable flow can overshadow the negativity saturating media outlets. Meanwhile, we have seen that the American Association of Individual Investor Sentiment Reading remains fairly cautious, suggesting that many participants are still uncertain. Yet, ironically, that can be a bullish indicator. If a big portion of the public remains cynical toward new peaks, we are far from the euphoria that historically heralds a major market top. In other words, negativity actually helps to sustain the climb when plenty of investors are still on the fence rather than piling all in. Moreover, the appetite for risk is gradually creeping upward in the United States. Growth stocks, once considered more volatile, are increasingly viewed by a certain cohort of investors as the new safe bets, at least compared to value plays that might require more patience to see big returns. That is a startling turn from historical norms. It ties back to the broader theme. The entire concept of risk may be shifting, as unstoppable monthly inflows infuse a sense of stability into the markets, making even higher risk sectors appear less daunting. On the other hand, many international regions remain skittish, leaning into value stocks or traditional safe havens, in part due to concerns that the global economy is still on shaky ground. This divergence creates an interesting dynamic. If the United States continues to experience strong flows into equities, while global investors maintain caution, we may see unique arbitrage opportunities or cross-border investments down the line. The bigger question is whether the worldwide financial community will eventually embrace the monthly investing culture on the same scale, shrinking the performance gap that has recently benefited United States-based growth. At this juncture, some voices might be wondering, is it wise to become complacent? That is a fair question. Complacency is not the same as strategic confidence, and it is always prudent to have a sense of your risk tolerance. However, the data repeatedly show that tunnel vision on looming catastrophes robs investors of compounding benefits. This is the veil that Lynch attempted to lift. If you let your nerves push you out of the market every time you feel queasy, you could be leaving an enormous amount of long-term growth on the table. If you are intrigued by these ideas and you want more deep dives on how psychology and institutional structures shape our finances, feel free to subscribe or follow along so you will never miss new insights. After all, the more we educate ourselves on the frameworks that move markets, the better prepared we are to ride through volatility and stay focused on genuine opportunity. In truth, it is somewhat awe-inspiring to see how unstoppable monthly contributions might continue to lift the equity markets. There could come a time when the concept of the big crash is far less severe than it used to be. Corrections will still exist, but they might be shorter and shallower, precisely because ordinary workers keep adding capital, regardless of the latest sensational headline. Headlines shift from hyping inflation to job redundancy from AI, from global politics to corporate missteps, but in the background, a mighty river of contributions flows straight into equities. That is why some experts anticipate that forward valuations may continue to climb. If investors accept lower returns in exchange for less stress, valuations rise. The bedrock of stable monthly inflows, even in uncertain periods, anchors confidence. Reality might not match the darkest news predictions, and that mismatch only becomes more striking when the big indexes defy the headlines again and again. Indeed, the final question is whether the rest of the global economy might eventually follow suit, adopting similar retirement investment structures and fueling markets even further, or if something unforeseen could shift investors away from equities en masse. Granted, we cannot ignore that many people feel left behind by these surging markets. Not everyone has the luxury of consistent contributions, and some carry heavy debts that overshadow the notion of investing. But ironically, that might drive policy discussions about better saving incentives, possibly broadening the participant base, which in turn further props up the tide of monthly inflows. Ultimately, it is worth recognizing that this phenomenon is not about crowning a perpetual bull market, but about revealing the quiet yet massive impact of steady, patient capital from regular folks who invest each paycheck. The effect is enormous, and it unveils a whole new dynamic in modern finance that could keep rewriting the old rules. With that, we have explored how unstoppable monthly investments are upending the market's usual volatility, how growth stocks are being recast as less risky, and how negativity continues to be overshadowed by wave after wave of new capital. Peter Lynch's original counsel, not to let the news whip you into a panic, now seems more relevant than ever. While none of us can predict the next big crisis, we can see that ignoring passing headlines may well be the strongest shield against missing out on the unstoppable climb. That brings us to the end of this deep exploration of how retail might just be one-upping Wall Street in the modern trading landscape. As you process these insights, remember that the real key to investing success might be surprisingly simple. Keep a steady hand, stay consistent, and do not let the daily barrage of headlines throw you off course. Even the loudest warnings can sometimes mask the true power of a patient strategy aligned with unstoppable monthly contributions. Thank you for joining us on this journey. If you found this deep dive valuable or eye-opening, feel free to tap that like button to let others know the conversation is worth tuning in for. It helps us grow and keeps us eager to bring you more compelling analyses of the trends shaping our financial world. Until next time, keep your perspective wide, your emotions steady, and your focus on the powerful undercurrents that might just defy every doomsday headline you read. Hang on and watch closely. Retail investors might be just getting started.